Imagine walking into a bank. You and your partner have great jobs, a solid down payment, and are finally ready to buy your first home. You sit across from the loan officer, fully expecting a quick approval. But instead, the officer slides a sheet of paper across the desk. You're approved, but the interest rate on the loan is staggeringly high. It's so high that the monthly payments will stretch your budget to the breaking point. Your income isn't the problem. The bank knows you make plenty of money. The issue is an invisible number running quietly in the background of your financial life, your credit score. When the lender pulled your files, they saw two very different profiles. One of you has an excellent score of 780, but the other is sitting down in the red zone at 580. In the American financial system, no amount of hard work or salary increases can erase the drag of a poor credit history. If your score is low, lenders see you as a risk, regardless of the size of your paycheck. A credit score is simply a 3-digit grade measuring how likely you are to pay back money you borrow. Banks, auto lenders, and even landlords use it universally to decide how much your debt should cost. This graph shows how a 200-point gap creates a massive penalty. Over a standard 30-year mortgage, the higher interest rate attached to that 580 score forces this couple to pay tens of thousands more in interest compared to a loan secured with a 780. Ignoring this invisible number siphons money from your pocket long after you've closed on a home. It quietly drains the wealth you build over decades. To understand why a bank would penalize a high-earning couple, we need to look under the hood at the exact data feeding the algorithm. This chart breaks down the 5 factors of your score. The biggest chunk, 35%, is payment history. Partner A has a flawless record of automatic payments. Partner B, however, missed a single credit card payment over a year ago, and that one red mark is still actively dragging down their score. Right behind that, making up 30% of the score, is credit utilization. This is a simple ratio measuring how much of your available credit you are actually using at any given moment. Partner A consistently pays their balance down to 0. Partner B recently maxed out a credit card to buy new furniture, pushing their utilization dangerously close to their maximum limit. Lenders track this closely to judge your proximity to a financial breaking point. Every month, they are calculating exactly how much room you have left before you run out of options. The remaining 35% of the score is split between the length of your credit history, new credit applications, and your credit mix, the variety of loans you handle. This is where Partner B fell into a common trap. In an effort to clean up their finances before house hunting, they closed the very first credit card they opened back in college. Closing that account immediately deleted their oldest historical pillar. Their average credit age plummeted, and the algorithm penalized their score for having a shorter track record. Partner B never realized what went wrong because they firmly believed a popular myth, that checking your own credit report would lower your score even further. There is a massive difference between a bank pulling your credit to issue a new loan, a hard inquiry, which does cause a temporary dip, and a soft inquiry, where you review your own data. Checking your own report is entirely harmless. Avoiding your financial profile out of fear guarantees that minor, easily fixable errors will calcify into long-term barriers. Faced with an exorbitant mortgage rate, our couple makes a strategic choice. They pause their house hunt, letting the current listings go, and focus entirely on a step-by-step financial repair strategy for Partner B. Step 1 is locking in flawless payment history moving forward. They set up automatic transfers for every single bill, removing human error completely. Step 2 attacks their utilization ratio. They divert their spare cash toward paying down that maxed-out furniture card, forcing the balance back below the optimal threshold of 30%. Step 3 requires reading the actual report. They spot an old, inaccurate penalty lingering from a misapplied phone bill and initiate a formal dispute with the credit bureaus to have it legally removed. A bad score is never a permanent life sentence. The algorithm is a dynamic formula, and it responds directly and predictably when you change your financial behavior. Months later, the compound effect of those targeted, consistent actions takes hold. Partner B's score climbs out of the 500s. The on-time payments, the lowered utilization, and the successful dispute push the needle up and firmly into the good range. They walk back into the lender's office with a unified, healthy financial profile. This time, the bank evaluates the restored score and approves them for the optimal interest rate. Fixing that three-digit number practically bought back tens of thousands of dollars that would have otherwise vanished into 3 decades of interest payments. Your credit score dictates the financial opportunities available to you, but your daily financial habits have the absolute power to dictate your score.